Thank you everyone again for sharing the day with us. It is one of the high points of my nearly 40 years of working in the field of community development and social justice to have the opportunity to welcome my good friend, Vice Chair Michael Barr, back to Mississippi. When I first met Governor Barr, we were both much younger. We had a lot less experience, but it was very clear to me then, as it is even more now, that Michael was someone who had a heart that was dedicated to making the world a better place. He was a young advisor to Secretary Rubin, I think at that time, Treasury Secretary Rubin, during the Clinton administration. And we spent time on the floors and in offices of office buildings in Washington working on this crazy idea to inject private investment into communities like the Mississippi Delta. And one of the ways that got off the ground was by organizing a tour around the country that brought then President Clinton to Clarksdale, Mississippi. And Michael was deep in the weeds of organizing that. Later, I got to continue to work with him during his time in the Obama Treasury Department. We were in Little Rock, I think, and I was walking down the street and someone reached out, and it was Michael, and we ended up having dinner that night. And the next thing I know, I'm being invited by the dean of the Gerald Ford School of Public Policy at the University of Michigan to teach a graduate class about community development in places like the Deep South. And I am deeply honored to introduce him today. I've had the privilege of introducing then two sitting vice presidents, one who is now the president of the United States. I've introduced governors, I've introduced cabinet secretaries, but it's difficult to do justice to someone who I've known and respect as much as Michael, as I've seen roll up his sleeves in every role that he's been in, toward a goal of improving the lives of people who are disproportionately on the outside looking in. He's, as I said, played a pivotal role in so many things that has made his country better. The New Markets Tax Credit Program. He was one of the architects of Dodd-Frank and the Consumer Financial Protection Bureau. And I don't think we could be in a better place at this point in time when so many people are focused on financial inclusion and opening opportunities in the nation than to have Governor Michael Barr as the Vice Chair for Supervision at the Federal Reserve Board of Governors. Governor Barr, thank you for being here with us. Please welcome Governor Barr to the stage.
Thanks so much, Bill, for that incredibly warm introduction. I want to thank Hope and Jackson State University for inviting me to speak today. It is good to be back in Mississippi. It's just a wonderful formative experience, as Bill was describing for you just a few moments ago. It's Black History Month, and I feel privileged to be at this great historically black university, speaking on a topic of such vital importance to our country. As Bill described to you, I made my first trip to this state as a government official a quarter century ago to Clarksdale, Mississippi. I remember it was a sweltering July day, and we visited a local cabinet manufacturer with Bill Bynum, who, in my judgment, is one of the heroes of the economic justice movement. The company had received financing from Hope, which was then known as the Enterprise Corporation of the Delta. On that hot day, President Clinton called on banks to do more to meet the needs of their communities, to do more under a revamped Community Reinvestment Act, or CRA, and to help set up or support community development financial institutions, or CDFIs, such as Hope, partnering with the newly created CDFI fund at the Treasury Department, which had launched just a few years before. We were in Mississippi to highlight the need for the New Markets Tax Credit, a new initiative to provide tax credits to individuals and corporations for making equity investments in community development entities in places such as the Mississippi Delta. This, in turn, would help establish and grow local businesses, create jobs, increase local purchasing power, and generate more local investment opportunities. Congress enacted the New Markets Credit in December 2000 with broad bipartisan support. Since its inception, CDFIs and CDEs have used the program to support a wide array of job-creating businesses that increase local access to goods and services, as well as to increase the availability of important community infrastructure, such as rural hospitals and the kind of water infrastructure that we heard about earlier today. To date, the New Markets Tax Credit has awarded over $71 billion, which translates, among other things, into 857,000 jobs and almost 239 million square feet of commercial real estate. In addition, the CDFI fund has awarded more than $5.5 billion in grants and guaranteed over $2 billion in bonds. These programs and others like them also enable CDFIs to increase access to financial services in underserved communities, which can lead to opportunity and greater economic mobility. This morning, we heard insightful discussions about economic mobility in the Deep South, including how to create ladders of economic opportunity and the important role that access to financial services plays in economic mobility. We all have an interest in promoting a vibrant economy, as well as resilient families and communities. In such an economy, people would have access to credit on fair and equal terms to build a secure financial foundation. Yet despite widespread acceptance of this idea, we have a long way to go in making it a reality, particularly for Black households. I'm going to speak to three drivers of this disparity and three ways that the financial service community could work together to address them. First, there are significant and troubling disparities in lending outcomes for Black individuals and businesses relative to others. While research suggests that progress has been made in addressing racial discrimination in mortgage lending, regulators continue to find evidence of redlining and pricing discrimination in mortgage lending at individual institutions. Recent research on auto lending data indicates that racial bias may lead to higher rates for Blacks on financing to purchase cars. Another recent study finds that automating decisions reduce disparities in lending to Black-owned businesses in the Paycheck Protection Program, suggesting persistence of discrimination in that market. And the Federal Reserve's survey of small business credit has found that over many years, Black-owned businesses reported more significant credit access challenges, including feeling discouraged from even applying for credit, being denied credit, and being approved for less than the amount they originally applied for compared to other business owners. Compounding these challenges is the racial wealth gap that we've heard all about this morning. Federal Reserve data from 2019 show that white families had about 8 times the wealth of Black families. White families had a median wealth of approximately $188,000 compared to $24,000 for Black families. Lower levels of wealth make it difficult for people of color to finance a down payment for a home, invest in education, or establish a small business, all central to the American dream. These low levels of wealth also make it difficult for Black families to weather emergencies, such as job loss, or pay for unexpected expenses, which can lead to eviction, repossession of vehicles, and other devastating consequences. And there are more broadly disparities in financial services. While there has been significant progress over the last 25 years in expanding access to banking services, the Federal Deposit Insurance Corporation's most recent annual survey of the unbanked and underbanked found that the unbanked rate for Black households was 11.3%, compared to just 2.1% for white households. The unbanked rate for black households in Mississippi was more than double the national average for black households, 23.2%. Lacking a bank account can present challenges for saving, leading to the same insecurities I noted above, and lead to reliance on expensive alternative products. In addition to higher unbanked rates, only 48.8% of black households nationally had a credit card, compared to 78.1% of white households. Credit card ownership rates were even lower in Mississippi, at 28.4% for black households, compared to 64.5% for white households. A credit card not only provides a buffer for unexpected expenses, it also allows individuals to accrue credit history, central to accessing credit in the future. Now, let me turn to some ways to make progress. I'll set out 3 areas in which financial institutions and regulators should do their part to address these issues, although the issues are complex and multifaceted, and there are no easy solutions. First, eradicate discrimination in lending and other financial services, and protect consumers from other unfair, deceptive, and abusive practices. It's incumbent on financial institutions to devote resources to stamp out these practices, and on regulators to reinforce the importance of this goal through supervision and enforcement. Second, look for opportunities to support a vibrant and thriving economy for the benefit of everyone. This means seeking out opportunities to invest in low and moderate income communities, small businesses, and community infrastructure. Third, develop products and services that can help people save and build wealth. I'll start with the first one, our collective responsibility for eradicating discrimination in underwriting, lending, and other aspects of financial services. For most of our country's history, the United States government and many state and local governments, as well as many private individuals, corporations, and organizations, did not merely fail to protect minorities from discrimination, they actively reinforced segregation, entrenched inequality, and enforced unequal policies, including through brutal violence. The civil rights movement brought about changes in public opinion and in law. Discrimination in housing and lending became illegal in 1968 and 1974, respectively, through the passage of the Fair Housing Act and the Equal Credit Opportunity Act. Congress passed laws such as the Community Reinvestment Act of 1977 to remediate redlining. But history casts a long shadow. How can we, both banks and regulators, understand and address these problems where they persist? To start, there are some areas where we need better data. For example, as you heard earlier this morning, small business lending data required by Section 1071 of the Dodd-Frank Act, once implemented, will provide tangible insights into the availability and pricing of credit for minority small businesses. Banks should also actively analyze their own data to identify areas where racial disparities occur. On-the-ground testing, including techniques such as mystery shopping, may also help to identify discriminatory practices. And to the extent that a bank uses artificial intelligence or algorithmic systems in making lending decisions, they should review the underlying models, such as their credit scoring and underwriting systems, as well as their marketing and loan servicing activities, just as they should for more traditional models. Racial bias in the residential real estate market has long been noted as a source of concern. In January, the Federal Financial Institutions Examination Council's Appraisal Subcommittee held a public hearing on appraisal bias in the residential real estate market. I look forward to working with my fellow regulators to help ensure that individuals are treated equally in the appraisal process, regardless of their race or the racial composition of their neighborhood. The Federal Reserve and our fellow regulators have a clear responsibility to use our supervisory and enforcement tools. All firms have a responsibility to operate in a manner consistent with safety and soundness and in compliance with laws and regulations, including those related to consumer protection. Congress provided regulators with supervisory and enforcement tools to help ensure that the supervised firms resolve consumer protection weaknesses, as well as the more pervasive risk management issues that often lead to these weaknesses. We have a close working relationship with the Consumer Financial Protection Bureau and our other regulators, and integrate other regulators' consumer-focused reviews, such as examinations for unfair, deceptive, or abusive acts or practices, as well as fair lending, into our assessments of bank holding companies, including in the context of applications for mergers and acquisitions. Such collaboration is critical to ensure a level playing field and strong consumer protection enforcement. More generally, there is another obvious reason for banks to do all they can to eradicate discrimination in lending. It is simply good business. Ensuring that all would-be borrowers are treated equally means more customers, more loans, and better returns for banks. But even if we address current discriminatory practices, we're still left with the legacy of discrimination and redlining, which helped perpetuate economically depressed black neighborhoods. Historically, these neighborhoods have not had the benefit of robust credit and financial services, which hindered their growth and left them less economically connected than wealthier neighborhoods. This lack of connectivity can have a large impact on an individual's economic mobility. Before turning to the role of regulators, let me first speak a bit about the role of private institutions in supporting these communities. First, CDFIs and minority depository institutions, or MDIs, are critical because they deliver basic financial products to places and people often left behind by other financial institutions. Compared to other banks, MDIs originate a greater share of mortgages to minority borrowers and borrowers who live in low and middle income census tracts. And they played a critical role in dispersing the PPP funds you heard about earlier today. Recent legislation bolstered the CDFIs with funds from the Emergency Capital Investment Program, or ECIP. Hope Federal Credit Union estimates, for example, that ECIP funds it received will allow it to double its consumer, mortgage, small business, and consumer lending portfolios over the next 6 years. And Hope was able to mobilize $140 million of PPP funds to small businesses. Community banks and credit unions also have an important role to play. Through their lending to local communities and small businesses, they often know their customers personally and engage in community building activities, as you heard from Andy Anderson earlier today. Large banks also have a key part to play. For example, in 2022, many large financial institutions initiated or expanded special purpose credit programs of the kind that you heard about earlier this morning, many of which provide mortgage assistance to benefit Black and Hispanic communities. In addition to their own lending, these firms help MDIs and CDFIs through technical assistance and investment. They often share expertise in technology, business support, tax considerations, and bringing programs to scale. And is often the case, the impact can be greatest through collective efforts, as you're hearing on the panel just before lunch. In 2015, while I was at the University of Michigan, I helped a former student, James Walls, design a program to bring together a local CDFI, philanthropies, and several banks to launch the Entrepreneur of Color Fund in Detroit. The fund extends credit to small businesses in Detroit that otherwise might not qualify for bank lending at the rate of about $2 million a year. And that same approach is now being used by 8 additional cities and involves more than 20 local CDFI partners. Closer to home, Hope, together with a large bank and a set of HBCUs, has partnered to form the Deep South Economic Mobility Collaborative. This program provides capital, educational resources, and business support services to small businesses and entrepreneurs in the Deep South, especially those from underserved and under-resourced communities. Turning to the role of regulators, we should do what we can to encourage the private sector efforts I mentioned above. For instance, the Fed's Partnership for Progress helps MDIs navigate their unique business challenges, provides MDIs with resources of technical assistance, and conducts research on the unique challenges faced by LMI communities. We conduct and promote research on CDFIs engaged in thought leadership to explore ways to bring additional capital and liquidity to the CDFI sector. In addition, regulators should also ensure that our regulations provide appropriate incentives for banks to invest in LMI communities and lend to LMI households. The Community Reinvestment Act, or CRA, helps to address redlining and other systemic inequities in access to credit, investment, and banking services faced by LMI communities. The last major revision to CRA's regulations were made in 1995, and it's high time that we strengthen and modernize the regulations to reflect the many changes in banking since then. In 2022, the Federal Reserve Board, the FDIC, and the Office of the Comptroller of the Currency requested comments from the public on a proposal to do just that. Importantly, the proposal would encourage banks to expand access to LMI communities in ways that would expand home mortgage lending, small business lending, and other credit, to make community development investments, and to engage in lending and banking services. The proposal would adopt the regulations to address changes in the banking sector, including internet and mobile banking, and update the approach to assessment areas. It will also provide more clarity, consistency, and transparency for CRA evaluations and eligible activities. I support the overall objectives of the proposal, and I'm pleased that all three agencies are working together to have unified regulations. The agencies are benefiting from the thoughtful comment letters we received on the proposal, and all three agencies are hard at work finalizing the rule. Another area where Congress directed the board to consider the convenience and needs of communities is through our review of bank mergers. As I've said before, mergers are a feature of vibrant industries, but the advantages that firms seek to gain through mergers must be weighed against the risks posed and the costs and benefits to the community. There's likely important work we can do to improve our assessment of the convenience and needs factor for bank mergers. We also have an important role to play to ensure that our safety and soundness regulations do not needlessly impede financial inclusion. For example, banks can make investments that support LMI communities called public welfare investments, subject to certain caps. We plan to change our approach to computing the public welfare investment cap for state member banks using New Markets tax credits and similar credits, which would allow state member banks to make additional investments in low and moderate income communities. And as ESIP funds are made available, regulators have an important role to play in ensuring that our examiners are informed and knowledgeable about the work being conducted under these new programs. Last, let me turn to the need to develop products that are responsive to customer needs. As many have said, it's expensive to be poor. And many poor people lack any financial slack, such as savings, to tide them through an emergency. No slack often means that a small problem can snowball into larger ones. As a result, low and moderate income consumers often use alternative financial services, such as payday loans, which can help fill needs, but are often high cost and can lead to debt traps. There's an opportunity for traditional banks and mission-driven organizations to fill this gap, but to be effective, they need to understand consumer preferences and behavior to provide products and services that meet these needs in a safer and fairer way. Starting with customer preference, we know that speed can be key. Income disruption and unexpected expenses are more common in low-income households, and quick access to a loan can make all the difference. With proper safeguards, unsecured small dollar credit to consumers with less than prime credit scores can be very important in helping people to meet this need. We have seen banks begin offering small dollar loans to some existing customers by factoring account data into the provision of credit. Now there's a growing number of additional banks in this space. These products are typically available through the bank's online interface, which streamlines the process and speeds up decisions. Although some of these may be considered high-cost products, they're still less costly than payday loans or the cost of what many banks charge for overdraft protection. As an operator and regulator of payment system, the Federal Reserve also has a role in faster payments. We're working to launch FedNow, which once widely adopted, will better enable banks to offer customers the ability to send and receive money immediately at low cost. We can also make a difference by updating our rules on check clearance so that consumers and small businesses still receiving checks have access to their funds in a timelier manner. And of course, we need strong consumer protections in place so that consumers don't have to worry about making payments in a safe way. The Bank On initiative has been hugely successful in both identifying bank account features that meet customer preferences and getting these accounts into the hands of consumers. Strongly recommended features including low minimum balances, no overdraft fees, robust transaction options, and online bill pay. More than 46,000 banks and credit union branches across the country currently offer bank-on certified accounts, and more than 5.8 million bank-on certified accounts were open and active in 2021. In addition to considering customer preferences, prudent design should help counter, not lean into, biases that can lead to poor decision-making. Being aware of these risks can help banks help customers better understand the risks and structure products that are designed to overcome and not exacerbate these problems. For instance, banks should ensure that their overdraft policies frame financial decisions in a transparent and fair way and avoid unexpected and hefty fees. Customers should be empowered with timely information on balances so that they can avoid inadvertent overdrafts. And best practice builds in a grace period for consumers to cure their overdrafts. Some banks have eliminated overdraft fees entirely. Regulators need to understand both human decision-making and also the market context in designing the right rules of the road. Regulators also need to engage with techniques such as cash flow underwriting and alternative data, new credit models, and other technologies that hold out the promise to increase access and reduce bias in credit intermediation. Diversity in the workforce for financial institutions also matters for financial inclusion. For instance, working with minority loan officers improves credit access for minority borrowers, which suggests that underrepresentation of minorities among loan officers adversely impacts minority access to credit. And we regulators need to focus on our own diversity as well. To conclude, I've focused today on using the tools we have to address discrimination in lending, supporting communities, and developing products and services to meet customer needs. As I said at the outset, these are complex problems with no easy solutions, but we have an obligation to do our part. One final important role we have to play is encouraging awareness of these issues, and conferences such as these have tremendous value in this regard. On that note, once again, I'd like to thank Hope and Jackson State University for hosting today's event, and I look forward to your questions.
Thank you. Thank you. I think that as we have a short conversation, I'd like to encourage you to send any questions, write questions on the cards on your desk, and they'll be collected, and we'll try to address as many as we can. Governor, thank you. You covered a lot of territory there that is certainly very important to Hope, many of the groups in this room that work to promote economic advocacy, economic justice. I'm curious, you spent the time this morning, and I saw you taking notes. I know that you were engaged in the conversations. Were there particular points that resonated that you think could inform the Fed's work and help us to, again, broaden economic opportunity?
Thank you, Bill. Yeah, I really enjoyed the panels, all the panels this morning. I've often said to my team at the Fed, one of the amazing things about going into work every day in this job is I am absolutely guaranteed to learn something new every single day, and today was no exception. It's just a great gift, and I do take notes in my it's sort of a leftover from my professor days that I like to do that. I was struck by a few different things. One is the conversation about community infrastructure, particularly about water and wastewater, which I know is of enormous particular relevance in Jackson, given your experience here. I'm from Ann Arbor, Michigan, and up the road we have Flint, Michigan, where just had absolutely devastating consequences for the local community in terms of not having access to clean water. The thing that struck me that I didn't realize, and I should have known, but I didn't, is just how the limited infrastructure, particularly in small communities, rural communities, means that CDFIs have to step in and actually fund the water infrastructure to the extent of that was very striking to me, and really kind of demonstrates the importance of that movement, but also the lack of basic infrastructure that, I take for granted in the community that I live in Ann Arbor. You can't take for granted at all in our countries. That was one, I think, important lesson. I really liked what Dr. Wiggins had to say this morning about the importance of coming into a community with humility. I think that's absolutely critical to really understand what's happening on the ground, to even know what questions to begin to ask, and to be able to be an effective partner. I think you really have to, anywhere you go, understand your own limited role in that space. I got a special kick out of getting to hear the wonderful Donna Gumbrell up here. Donna and I have been doing work together for many decades, or I liked the better way you said it. You said for a little while.
More than a little while.
More than a little while. Anyway, it was just a lovely conversation. I look forward to continuing it this afternoon.
Thank you. I really do appreciate you underscoring the role that CDFIs, minority depositories, play in the financial sector. I think certainly more than when we were early in our careers, I think CDFIs are increasingly recognized as not as an interesting thing, but a critical part of the nation's financial infrastructure. And that is particularly important in places like the Black Belt and the Delta and communities of color, rural, high poverty places. We saw after the recession, we talked about the disparities in PPP, ARPA funds did not flow to small towns as readily as they did into black-led towns. Even Jackson, as easily as they did to more prosperous communities that had the social capital that Dr. Friedman talked about, and those communities that we work in don't. And so CDFIs play a vital role in connecting, in trying to bring those resources into under invested in communities. It's the default model in federal policy is to use banks, to use state government as the conduit to drive funds. And again, Mississippi is very different than Massachusetts in terms of the priorities. And so I'm curious if there are, other than obviously the influence, the incredible influence that the Federal Reserve System has, are there policies, are there regulation even that can help, or maybe not the Fed, but I guess you might be treading on fragile, on difficult ground to talk about what Congress should do. But again, if we know that, again, Kiad shared data about the difference between the level of SBA lending to entrepreneurs of color and their peers, then there has to be more intentional and focus on getting the resources in the hands of institutions that do lend to communities that have been historically underserved. And I just appreciate any thoughts you have on what the Federal Reserve can do, or what are some strategies to mitigate those realities.
Well, I think you're right, Bill, that, when you look at the evidence in the PPP program, and you and I were talking about this at the time in real time,
right.
The first round of PPP lending really was not reaching low-income communities and minority borrowers the way it should, and that had to do with the issues that your panelists were talking about earlier, which is, the relationships and the networks. And African American businesses did not have the same extent of networks and connections to the banks, and didn't have the network to the services that were actually required to apply for a PPP loan in terms of, the accounting and other services that are required to document that you're eligible for a PPP loan, and then to maintain the records to get the forgiveness under the PPP loan, which is also critical. And in the second and third rounds of those programs, you can see empirically that those programs opened up more as other lenders, especially CDFIs and MDIs, were able to direct more of those loans to minority borrowers. And so I think there is a important track record there, and it does suggest that as people are thinking about emergency programs in the future, that understanding that dynamic is really critical to the design of the program. One of the things that I think we can do, and I mentioned briefly in my remarks, is make sure that our examiners understand the CDFI space and the MDI space and the role that CDFIs and MDIs play, and the particular kinds of circumstances that MDIs and CDFIs face, such as being able to do small consumer loans and to do character lending and to lend to people without a credit score. Our examiners need to know and understand what the offsetting risk mitigation measures are that CDFIs and MDIs are using, including, knowing the family, and it makes a difference. So that's an example of an area. I think we can continue to provide support to MDIs and CDFIs with conferences and technical assistance and the like, and work with our fellow regulators on those approaches.
Thank you. I appreciate the work that you have done early in your career and continue to advocate for consumer protections. And Patrice and her colleagues at the Bureau do an amazing job, but we know that they can't be everywhere. And so I think it's a fact that while we need regulation to hold us all accountable for doing right and lending, and fair lending and consumer protections, things seem to gain a little bit more traction when people act in their own self-interest. And so what do you think are some of the more compelling economic arguments for financial inclusion?
Well, I alluded to this briefly in my remarks, but the basic, fact is, if you're a bank and you're in the business of making loans and investments for a return, you want to be able to reach everybody. You want to be able to make sure that you're reaching customers wherever they live, and whatever their background, whatever their race or ethnicity. And so, there's I think an important self-interest in serving everybody. And by the way, if everybody is getting access to financial services in a way that makes sense, the whole economy grows. That's great for everybody. So you've not just done something that's good for the bank and good for your customer, you've grown your economy. And when the economy grows, then, wow, it turns out actually more businesses form. And I have more customers I can serve if I'm a bank. And so there's a virtuous cycle that can develop if that initial investment is made, that initial choice is made to make sure that everybody is brought along.
I have the privilege of serving with your colleagues out of the Atlanta Fed on the New Orleans board of directors, and I think that my addition to that board was an intentional part of the system's intentional effort to bring more consumer voice into the boardroom and to these decisions, that the important decisions that the Federal Reserve makes. Clearly, Hope is not a large traditional financial institution. We're not one of the large employers who are more typically the voices in those rooms. And so I give the Federal Reserve System a lot of credit for bringing those voices more into the room. What are some of share a bit about that thinking and what some of the efforts to increase consumer voice in monetary policy?
Well, let me just say, our job in monetary policy is a complicated one. It's hard to understand what's going on in the economy. And we have a really, I think, critical job, which is in the current environment, making sure that we're meeting both of our congressionally mandated goals, that we're trying to achieve price stability and trying to do that in a way that is consistent with full employment. And right now we have really quite high inflation, so our job is to bring inflation down to 2%, and we're working hard on doing that. In figuring out how to do that, we're trying to get data from as many kinds of sources as we can, because understanding what's happening in the economy today is complex, and our basic models and our basic data inputs are insufficient for really fully understanding what's happening in the economy. So one of the things that's really important to us is that we have voices at the table who come explain what's happening in their own local community. And that's particularly important in low and moderate income communities and in communities of color, where we often get even less information than for other communities. And so having the community voice at the table is just critical. Some of that happens through the regional Federal Reserve banks and their branches, as you were describing. Some of that is happening in the process at the Federal Open Markets Committee table itself, at the FOMC, where we can hear voices from community development organizations. So we have ways that we regularly bring those voices to the table. And then we've just started a process where we're piloting having some community development officers from 4 of the Federal Reserve banks join in the monetary policy conversation in advance of the FOMC meeting, so we can learn further from local communities about what's happening on the ground. And I think it's proved to be quite valuable to me. Again, the data and our basic models are actually not enough to understand what's really going on in a society and economy as complex and differentiated as the one we live in.
I have to give a great deal of credit to the Dirk Slackton team in New Orleans and the researchers from the Atlanta, President Bostic's team in Atlanta, and how they lean in and listen so intently to the often different perspective that an organization like HOPE brings into the room. Again, our members, our average deposit of our members is a fraction of what a traditional, even a small community bank's deposits is, because there's just fewer resources in those communities. But it's interesting, many of the experiences that our members run into are similar to my fellow banks and the larger employers, but they have less of a cushion. They have less of a safety net, and so the interest rate increases. When you have to make decisions about buying food or buying medicine, healthcare, those are real, and you have less resources to draw on. Those are very difficult, and so I do appreciate how the team at the bank's Federal Reserve listens to that data, and I know it gets reported up, and I think that's critically important, because what is the economy if it's not consumers? Right.
That's most of the economy.
That's right.
And I think you're right, Bill. When in our conversation with the people, and consistent with your own customers, what we're hearing from people is that inflation is really painful, particularly if you are a low and moderate income person and you're trying to make ends meet. We need to bring inflation back down to 2% for people to be able to not think about it again, and to go back to living their lives and feeding their kids and taking them to school and so on. So that's why that mission is really front and center right now.
I think it's really appropriate that as a law school and policy school, law school professor and policy school dean, for you to be here on the campus of Jackson State. I know we'll be going over to Tougaloo College tomorrow, and many of the students that are here to talk about the potential careers in the financial sector, in the policy-making side of the financial sector, and I appreciate your engaging the students. And President Bostic is going to be spending some time with them, as well as your colleagues from the Federal Reserve System. I think that's incredibly important. You mentioned the importance of increased diversity in the Fed. What are some things that you think, other than being here with us and at the career fair, are opportunities to increase diversity in the Federal Reserve System?
Well, first let me say it's also, as I said at the outset, it's wonderful to be here at Jackson State and to be with so many students in the audience. One of the parts of my current job that is not as good as my old job is I don't get to spend as much time with students. I used to love as a professor and as a dean to be able to engage with students, and so to have that opportunity here and then tomorrow at Tougaloo is really wonderful. And I'm grateful President Bostic is joining for that conversation with the students. We actually started out together a couple days ago, 25-ish years ago. As young people, and myself at the Treasury and President Bostic at the Fed, when we were not that far out of school, and being able to have that experience and to get a taste for what it's like to serve to serve the public, to serve in the federal government, and to be able to see how finance can help people in their daily lives. Early in my career, that was a very inspiring kind of experience. So, I'd say, one thing in addition to the kind of outreach we're doing here is that if students can have that opportunity for that internship in college, that gives you kind of a taste of what a career in finance, a career in helping people might be like, and if you can marry those two things as Bill Bynum has done for his whole career, like what an amazing gift to be able to do that work. So having a taste of it early on, getting that opportunity to have an internship. I always tell students, find that thing that you love, find the passionate thing you love, and if it turns out to be at this intersection, that would be of great delight to me. But if it's not, you'll find a different path that's great for you. But if it's here in this space, I think that's an amazing thing you can take advantage of. You heard a lot about networks and social capital. That's important for this early stage of your career path. And so making sure you reach out to the Federal Reserve staff who are here, to the staff of the CDFIs and banks who are in the room, to folks at the Consumer Financial Protection Bureau, use this opportunity you have sitting in this room to connect with people and build that social capital, build those networks that will help you understand what it is you want to do and get a job in the future, I think is really quite critical. I think we can do more and to expand diversity at the Federal Reserve and in the Federal Reserve System. And these are just some of the ways that we might be able to be helpful.
Thank you. I appreciate you making that a priority. I'd ask, are there any of the students that have a question that they would like to put to Governor Barr? I don't think you all are shy. I appreciate you being here, but if there is a question that you'd like to put forward, please do. Yes, please.
Crystal Ammon, Southern University Law Center. I have a question as a governor, and you spoke about equity in the financial sector. And so we've been inundated with facts and figures, which I think is wonderful, right? Because it's the foundation of change, is realizing that we need change. What are you doing with other governors of other states to further the conversation, to foster those types of conversation and to foster that sort of change, and to bridge the gap, as it were?
Yeah, I would say, the topic of equity and of financial inclusion is very much a part of our conversations on the Federal Reserve Board among the governors. And many of us go around the country to talk about these issues. I know, for example, Governor Brainerd was in California just last week talking about financial inclusion issues. And it's also a topic of conversation around, we have this very complicated governance structure, but around the Federal Open Markets Committee table, which are the governors plus the presidents of the regional Federal Reserve banks. And the other kinds of things we do is build that conversation into the core of our economic research. So, for example, the economic staff, the research staff at the Fed now provide us with data that explains past effects of policy on racial composition of unemployment and makes projections about future unemployment by race and educational attainment, so that we can understand what the context for decision making. So the kinds of things that I think make it real and concrete within our own deliberations. And then the other kind of thing we can do is, when I come here to give a speech about financial inclusion, it turns out there are other people who want to read that speech. And so I feel like it's incumbent on me to make sure that as I'm making remarks around the country, that issues of racial equity and financial inclusion are an important part of what I talk about. It's a way of calling attention to it, a way of getting other people to focus on it and think about it.
Yes, it's one here.
Hi, my name is Naya Anderson. I go to Mississippi Valley State University, and my question kind of touches on actually majority of the topics spoken on today. And so I'll read it. With factors such as housing, income, and connectedness, how do you highlight that advocating and working towards these will drive change to individuals? I mean, as a child from a single mother, a teenage single mother, people born in low-income communities also don't have the privilege to see outside of the issues they face. So how do you say something like that to them? We're here and we can speak about this. I feel like I'm here because I'm in college, but there's a lot of people who didn't get to college. So how do you convey this to them, like, this will help us?
Yeah, I mean, I think that's super challenging, and you heard some conversation about it quite a bit actually earlier this morning. How do you make sure we're not in a moment, we're in a movement? How do you create networks that empower yourself? I think it's super challenging to do, but I do think it starts by being in spaces like this. I mean, you figured out what you needed to do to get into college, and you got yourself into this room. So my guess is you're going to figure out how to take yourself out of this room and do something big with it, and that's I think what matters.
And I'm also sure that you will take this information back to your community. It's so great to have some folks here from Itabena and from these HBCUs because you are in communities that disproportionately are underinvested, and you're and all of us. I know I am one. I have family and friends who live in communities that are bank deserts, that are opportunity deserts, and so I think it's incumbent on all of us who are in these rooms and who have benefited from some of the connectedness that Dr. Freeman mentioned this morning, to not hoard that. We've got to share it. We've got to reinvest in those places that helped us get where we are. I think that's critically important. I also think one of the things, and you didn't mention this, but that helps to translate these conversations to the real world is getting out of the boardroom, getting out of the ivory towers, and getting on the ground. Key shared that we have branches, offices across the Deep South. 75% of them are in high poverty communities, and the people in those branches are people who lived in those communities and who have family that needs the work, the resources that Hope brings, and so that helps us. I know also that, again, Governor, you didn't mention this, but you will be going back to Clarksdale.
Yeah.
And so I appreciate that. I know Governor Brainerd has been to the Delta. Many of your colleagues from the St. Louis and Atlanta offices have been on the ground in these communities. And, you know, as much as we try and as amazing speakers as we had here today, we can't tell the story as effectively as people in these communities can tell them themselves. So being proximate, as Brian Stevenson says, is necessary to understanding and to really pushing change forward. So thank you for taking the time, not just to be here, to go to Tougaloo and go up into the Delta.
Well, I'm really looking forward to it. You know, I'll have 3 days here in Mississippi today and tomorrow in Jackson, seeing some of the sites that Hope Credit Union has funded over the years, and spending some time at Tougaloo, and then going up to Moorhead and Clarksdale. And I really look forward to being back in Clarksdale after all these years. I haven't been back in a very long time. And it does, these kinds of opportunities to get out of Washington are very grounding. They're really important, I think, for policymakers to be in communities, to see communities, to talk to people, to get a wide variety of perspectives on the ground. And, you know, as I was saying before, like the just great gift of this job is the ability to just learn every day. And one of the most amazing ways to learn is to be out in the community. So I'm really looking forward to it.
Thank you. I'm curious. Governor Bahawel went to Valley. It was in Itabena a few years ago, and one of the things
he still talks about that.
One of the things that he said is that it was so important to him to engage with the students and to learn. And one of the things that he shared is that, and again, monetary policy doesn't work as well when you have so many people on the outside of the financial system. And so financial inclusion is critical. And so I want to thank you again for being here and for the work you're doing to help foster financial inclusion. We are, I think we're near the top of the hour, so we'll break. And as Ed mentioned earlier, we do have Jackson State's made space available for us to do a little bit of networking. I know there's another session for a few invited guests, a small round table. But I want to thank you all again for being here and sharing this day with us. But it's only going to be valuable if we take these conversations and build on them. If we do something and help someone climb the economic ladder. And so thank you for being here. I'm confident that we have the right people in this room. We have people in positions that care about these issues. And again, I'm inspired and confident that we will realize this potential. And it won't just be a moment. It will be a movement. So Governor Barr, thank you.
Thank you. Thanks, Bill.